Market breadth is one of the most important things to look at in intraday trading. The breadth helps you to gauge the weakness or a strength in the price movement and gives you extra confirmation. Hi everyone, my name is Numan Ashad, and in this video we are going to discuss the topic of market breadth in detail. To be very specific, we are going to discuss three major things today. Number one, what exactly is the market breadth or market internals? Number two, what are the components of those market internals? And we are going to have a deep dive on that. And number three, in the last, we are going to create a bigger picture and see how you can use those components and create a trading strategy and create a trading edge. And with that being said, let's have a deep dive. So breadth refers to techniques used to identify the overall strength of the market. These techniques basically confirm or deny if the move in the price action is strong or if it's rather a weaker move. So what happens is that if the breadth is strong, right, that showcases you a lot of participation, that showcases you a lot of momentum. If the breadth is weak and the price is also moving lower, that again showcases you a lot of momentum, that again showcases you a lot of participation. However, this is where things become interesting. If the price is moving higher, but the breadth is not really following, but the breadth line or breadth indicators are moving lower, that showcases you that the move on the upside is weaker, and there is a strong possibility that we could see some sort of exhaustion kicking in very, very soon. If we apply exactly the same concept on the other side, if the price is moving lower, but market internals remain very, very strong, that again showcases you that the price move on the downside could not be sustained. There is a very strong possibility that the price will revert, or so to say, find some buyers and will trade higher at some point. So the idea once again is that the breadth or sort of internals will confirm if the move in the price action is strong, if there's a participation on the move, and if the move is not fake. But the question becomes how exactly we measure that. And for measuring that, we have to look at different indicators. So some of the basic tools are the following. Number one is the tick. Number two is the ad, which is also the advanced and decline line. Number three is the VIX, which is basically the fear factor measurement in the Wall Street. And number four is TRIN, which takes into account the volume perspective in the price action, right? So overall, if you combine all these four basic indicators, again, I'm using the word basics because at the end of the day, there are tons of other things that you can use in your system and can make your system as complex as you want, or can make your system as easier as you want, depending on what exactly you choose. But in general, these are the four basic things that can give you a pretty good idea on if the price move is also followed by or basically corroborated by big participation, and if there's a strength and momentum in that move. So with that being said, let's have a deep dive and let's discuss all these things in detail. So let's first of all look at ad. What exactly is the ad? How you can use the ad to identify strength or weakness, and what are the ad divergences? Ad is the advanced decline line in breadth indicators based on net advances. That is the number of stocks advancing less than number of stocks declining, right? So as you guys know, in general, let's take an average 3,000 stocks, right? And if the price is moving higher, and let's say there's a strong contribution from this set of stocks, let's say the ad line is 2,300 or 2K or anything of that sort, that is going to give you information that the move overall is very strong. Why? Because a lot of from all of these 3,000 stocks, the majority of the stocks are participating in the market move higher. Why? Because as you guys can see, the way ad is calculated, it takes the number of stocks that are advancing and minuses the number of stocks that are declining. It measures the degree of participation in the market, right? Similarly, if the price is moving lower and the ad value, ad readings are contributing into that price movement, that is again showcasing you that the participation move on the downside is very, very strong. Now, how we can use ad to identify strength or weakness, right? Once again, ad is just one of the components in the toolkit, right? If you get a very, very strong positive ad readings, but other components, other indicators are not really aligning, that does not mean that you should just go ahead and buy calls. And similarly, if you are getting very, very strong negative ad readings, that does not mean that you should just go ahead and buy puts. The idea is that this is one of the components in the entire toolkit that you can use to combine with other things that we are going to discuss later to build a comprehensive picture. So first of all, let's look at how you can use ad. In your brokerage platform or whatever charts that you are using, you will put the ticker ADD and it will showcases you a line, right? You can change that to a histogram, you can change it to whatever way you want to basically add data to visualize. Either you will get a very, very strong ad readings, or when the market opens, you will get very negative ad readings, right? The most important thing for you to gauge if the market is strength or weak is, first of all, the opening print, where exactly we are opening, right? Number two, and that is the most important, the progression from that opening print. And once that progression is happening, you want to align that progression with the price movement as well. So let's say if the ad opens at 1K, or if it opens at 1.2K, that is sort of average / mild bullish reading, right? And let's say it starts at 1.2 and it starts trending higher. 1.5, 1.8, 2K, and the same time the price is moving higher. So as the progression is happening, as this line is trending, it is also showcasing you that, okay, a lot of stocks are participating in this move higher, and that is a positive momentum move on the upside. Similarly, on the downside, let's say that the ad opens at 1.1K and the price opens with a gap down, or the price opens on a very, very weak note. What you want to focus on again is the word progression. How we move forward from this point going into the session. If we start trending lower and the price also keeps on moving lower, that again is showcasing you that this move is corroborated by a lot of folks, that there is a lot of activity happening and the folks are moving the price lower with the volume, and a lot of stocks are participating in the move. Now, things become very, very interesting when there is something called ad divergence, right? What exactly is a divergence? A divergence is when the market internals showcase you one picture, but the price action showcases you another picture, right? As we just discussed, for the bullish momentum, you want to see ad to trend higher as well. For the bearish momentum to continue, you want the ad line to participate in the move as well and corroborate that with the price section. But what happens if there are divergence? What exactly is a divergence? A divergence is if the price moves higher, but the market is not participating. The ad line is not really showcasing you that, right? What is one interpretation of that move? One interpretation of that move is that big stocks like Apple, like Amazon, or like Nvidia, those are the ones who are possibly trending higher and who are possibly making the move higher, right? So what are the possibilities? The possibilities are that once those stocks exhaust, and given that there is literally no participation from other guys, there's a good possibility that the price will revert. Now, the third case scenario is that the price is in a range bound and you also are not really getting any strong values on ad. What is that showcasing you? That's showcasing you a possibility of a choppiness conditions, right? That the price is just range bound, that there's not really a lot of strong participation on either side. And there is again a good probability that we don't break out, that we just go for a range bound session or a balance session and we don't really get very, very strong moves. That is advance and decline line, one of the components in the toolkit that you can use to gauge the strength or weakness of the market. Now let's move to the next component in the toolkit, and that is wicks. And we're going to discuss what is wicks, how you can read wicks, and what are the wicks and price action examples. So wicks measures the volatility and panic in the market. It is also called the fear indicator in the Wall Street. The way it is calculated is quite interesting because, to be very precise, it measures the 30-day expected volatility of S&P index by looking at the near-term call and puts option, right? And as that volatility increases, the value of VIX increases. As that volatility dies down, the value of VIX comes down. But in general, it is a very, very good metric to look at. It is also called the fear indicator in Wall Street, and it is a very, very important thing to focus on when you are trading S&P or whenever you are trading anything overall. Now, the question is how you can read wicks, right? There are some general parameters that you should focus on when you are looking at wicks. We can categorize those parameters in three major categories. Category number one, reading between 12 and 20. That reading is considered a normal reading. That reading is considered very average reading that showcases you that there's not a lot of panic in the market. The markets are functioning, behaving in a normal way. The second is VIX below 12. That is typically considered too low. Third is the VIX level above 20. That is considered a high level. That is where some sort of volatility kicks in. That's where the pressure in S&P kicks in or in the markets kick in. That's where things start going towards volatility and panic mode, right? Again, overall, wherever the index is, what you want to focus on again is a progression. Let's say if VIX opens at 14, right, and it starts trending higher, even though in general it will be considered a normal wicks, it will be not categorized as a market is going to just die today. But if, let's say, if the progression from 14 to 17 is going on, let's say, in a positive momentum, it is going to possibly give you some good moves on the downside in S&P. Why? Because the VIX values are inversely correlated with S&P. What does it mean? It means as VIX values go higher, S&P moves lower. And as VIX values go lower, S&P moves higher, right? So this is what you mean by inverse correlation. There have been some exceptions lately, especially in the bear market, when VIX did not correlate with S&P price movement, and that was due to some hedges, due to some manipulation in the market, due to the reason that dealers were heavily adjusting their positions and trying to intentionally suppress the VIX. That was a very, very exceptional case. But in general, the values are inversely correlated with the price of S&P. Right. Here is a very, very quick short example of VIX. This is, as you guys can see, when we had a strong move on the downside, the bear market. Look at the exhaustion or the move upside on the VIX, right? And as you guys can see, as the VIX sort of died down or tried to settle, look at the 20 level as we just discussed, S&P started moving higher and the price moved higher, right? So there's a very, very strong inverse correlation overall. As we just discussed, even though we found a bottom at 20 and this area could be considered normal / little bit of panic, it very much depends on the type of move, the type of context that the market is trading, and the progression from the previous values. The third component in the toolkit is called tick. So we're going to discuss what exactly is tick, why is it important, and how to understand its reading. Tick summarizes the number of stocks on NYSE or NYSE that are increasing in price versus the number of stocks that are decreasing in price from the previous price quote. This is how the price structure will look like whenever you open tick, right? You do see a massive sort of a messy structure here, but there is a way to interpret that. But the most important thing that you guys should take into account is the tick is the most real-time information value that you could get. Right? This is as real time as it gets. This literally showcases you the pulse of the market. What is happening right now? What is the sentiment of the market right now and how the stocks are trading, right? So this is the most real-time information that you could get from the tick value. So let's look at how to interpret this messy chart. And in general, there are three big categories to look at the readings, right? One is the reading for the bullish momentum. Whenever you have readings above 600 and the readings stay constantly above 600, right? That is the minimum mark. The reading bases above that level and starts trending higher or constantly gives you a higher reading, that showcases you bullish momentum participation. Similarly, if you have readings below 600 and buyers are not really able to give some momentum and the reading constantly stays below 600, that is showcasing you that bearish momentum is possibly building up. Now you also have a reading for noise and chop. That is a reading between plus 400 to minus 400. Whenever you see tick oscillating between these categories, that usually is an indication that the market is possibly going to chop and could not give you some high A plus probability setups. So this is quite simple. This is quite straightforward. These are three big categories to look at. That is where you see what the reading is. If the reading is above that certain value, if the reading is below that certain value, and if the reading is in between that value, right? And then you corroborate that with the price action. Whenever the price is, let's say, trading in a range and not really showcasing, and the reading is also not really giving you any strong indication and is staying between plus 400, minus 400, that is usually an indication that you should sit on hands and not really take any solid trades. Similarly, if you see the price, let's say, consolidating, but the reading continuously showcasing you very, very strong number, let's say plus 600, plus 700, that is showcasing you there's a good possibility that the price will move and break out on the upside. Similarly, if the reading continuously stays below 600 and the price is consolidating, that again is showcasing you that there's a good probability, again using the word probability, not certainty, that the price will possibly break on the downside. Now there's something else which is also very, very important in when considering tick readings, and that is called extreme readings. What are the extreme readings? Extreme readings are whenever you get readings such as plus 1000 or 1.2K. Similarly, minus 1000 or minus 1.2K, anything above 1000 or below 1000 range, these readings are considered extreme readings, right? What does that mean in terms of the price action? It means that there's a good probability that the price is going to revert. So let's say if the price, if S&P is moving higher on a very, very strong note, and suddenly you get 1.2, 1.4K, whatever XYZ, anything above 1K reading, very, very strongly you're gonna see a pullback, right? And there are a lot of folks who actually look for those particularly setups that whenever they say exhaustion reading, right, they take the opposite position. So for the same on the downside, minus 1.0 XYZ number, they will, the market is dumping, they will take a long position with the expectation that we are going to get a very, very strong and quick bounce. And similarly on the upside, right? But that again, as said, is an extreme scenario that does not happen. Usually you see this sort of behavior when the readings stay in these categories, and then you can correlate that with the price to see what exactly is happening under the hood. So with that being said, let's move on to the last indicator for today for this session, and that is called TRIN. So what is TRIN? We are going to look at how to understand its readings and what are advantages and disadvantages of TRIN. So with that being said, let's have a look. TRIN puts a focus on the volume. It measures the relative rate at which volume is flowing into advancing stocks versus declining stocks. Whenever you put the ticker TRIN into your brokerage platform, you are going to get a reading that is in between 1 and minus 1, right? Now, how to interpret that readings? Let's look at it and let's break it down. TRIN showcases you the reading in single-digit format. If the volume goes into advancing stocks, then into declining stocks, TRIN will fall and gives you a value below 1, right? Similarly, if the volume goes into declining stocks, then into advancing stocks, TRIN will rise above 1, right? So you will get a reading between a 1 range, +1, -1, and that's pretty much it. Now, be careful whenever you are using TRIN, is because it could give you inaccurate readings. And the reason for those misleading readings is because the emphasis it puts on the volume. Have it in your toolbox, align it with other indicators, and see if the readings are aligning together or if there's a divergence. So let's sum it up. Let's create some scenarios, right? Let's create a picture. Let's create, first of all, the bullish picture. What do you want to see for a bullish picture, for a bullish scenario? You want to see strong readings across the board, right? You want advance and decline line to give you a very, very strong reading, or open at a strong note and gives you a progression towards strong numbers, right? Second, you want VIX to give you a negative reading or go for a downward progression. Third, you want to see TRIN to align with the above readings as well. And fourth, you want tick to stay above 600. If all those 4 components align together, that is going to tell you that the participation of the move, that the health of the market, that the price movement, if the price is moving higher, that the engagement of participants in this price behavior is very, very strong. And there is a very good possibility that we get a trend day. Now let's look at the second scenario. And the second scenario will be the bearish case scenario, right? For the bearish case scenario, you want to look at exactly the same thing. You want to look at advance and decline line moving lower or open and start dumping, right? Again, you want to focus on the progression. Second thing you want to look at is the VIX to keep on pumping or going towards the positive readings, right? Third, you want to look at tick continuously giving you negative readings, staying below -600 or starting below -400 and going towards 600 and going towards extreme levels. And fourth, you want TRIN to align as well. If all those 4 components align together and give you a reasoning or give you an idea that the market is weak and the price of S&P is also either consolidating or showcasing weakness, that is going to give you a very, very strong indication that there is a good probability, again using the word probability, not certainty. There is a good probability that the price will break on the downside or trend lower. And at the last, let's look at the third scenario. That is the chop scenario, right? The chop scenario will be if you really do not get positive readings, or if you do not really get any strong negative readings, but the readings overall stay in a range bound move, right? So let's say if ad is not really showcasing you any strength, the readings are +800, -800, right? There's no real progression, +1K, -1K, oscillating between 1.2, -1.2. So there's no strong conviction on the ad side. If you look at VIX, it is giving you range bound behavior. If you look at TRIN, also showcasing similar sort of picture. And if you are looking at tick, it is also oscillating between plus and -400. What does that mean? It means that the market is in a range-bound behavior, right? The market is not really willing to break out, that the fair value of the day has been established and is accepted by all participants, and no one is really looking forward to break out. So that will be a chop/range-bound scenario, right? So these are all the 3 big scenarios. This is how you can integrate all those indicators that we just discussed in this session today and try to make a picture, try to understand if the move in the price section for the session is strong, right? If there is a participation under the hood. And number 3, what are the probabilities based on this behavior that we could, let's say, get a trend day, or we could get a range bound day. And by looking at these things, then you can plan your trades, then you can set your risk management, and then you can look for A+ setups. So with that being said, let's have a deep dive and let's look at the price action for today, and let's look at market internals and try to create a picture. Right. So the platform in this, the platform that I'm using is called Think or Swim. And let's try to look at all the internals that we discussed. So the first thing I'm going to open here is ADD, add advanced and decline line. As we have discussed in detail, this advanced and decline line showcases you the participation, the momentum of participation in the market and the price action, right? Second thing that we are going to look for today is VIX. This is how the 5-minute chart on VIX looks like. Third thing that we discussed in detail was TICK. This is how a tick chart will populate. And the last thing will be TRIN, right? TRIN, as we discussed, focuses on the volume side. So if we look at today's example, what we are seeing that ad opened on a positive note, but since the open, it has been trending lower, right? Which means that there is no real momentum on the upside, and actually folks are moving the price on the downside. The participation on the downside has been strong. Look at the progression and look at the acceleration on this chart, right? If we look at the VIX side, this is very much corroborating the story. VIX is trending higher. Look at the open and look at the progression. If we look at the tick, exactly what we discussed as the base case, that we have 0. The reading is not able to get above 600, which, as we discussed, is a bullish zone. In fact, we are continuously trading lower, and this again is showcasing you that for today's session, the momentum in price is on the downside. And the last thing that we discussed today in the breadth section is the TRIN, right? This is also giving you a negative reading. So if we combine all these 4 indicators together, what are they telling us? They are telling us that for today's session, there is more momentum on the downside than the upside. Right? All these 4 things are aligning very well together. And if you look at the price for SPY, how the market moved today, look at that. We consolidated. The breadth is telling us that bears are in control. And look at the move that we made on S&P all the way from 444 to 440.98. Right. Similarly, as we discussed earlier, this is exactly what you want to see on the bullish side as well. You want to see all these breadth indicators aligning, and same for understanding or same for identifying the chop condition. You're not really seeing any momentum on these indicators are not really, let's say, breaking out or breaking down. That again should showcase you that there's no much conviction on the price for the session. So this is a quick analysis for today's price action. As we said, breadth indicators internals are aligning very, very strongly, and price is actually moving exactly the same way, as the indicators are telling us. So with that being said, let's sum it up all together. As we discussed today, market breadth is the most important things to look at when it comes to intraday trading. It gives you real-time information, and it helps you to confirm or deny your hypothesis on a bullish momentum trade or on a bearish momentum trade, and gives you extra confirmation and tells you what exactly is going on under the hood. These are some of the basic indicators that you should have, that every trader should have in his or her toolkit, and look at those indicators to confirm the behavior of the price. You can look at order flow, which is another important topic that we discussed previously on this channel. Combine order flow, combine the tape with market internals, see what exactly is going on under the hood, and take A+ setups. Thank you so much for watching this video. I hope this video provided you guys with some value. Go ahead, hit the like and subscribe button, and I will see you guys in the next video.